Good afternoon, everyone, and welcome to our session about understanding the Public Service Loan Forgiveness program, as well as the temporary waivers that were announced in October. I'm really pleased to be here today, and I just want to thank our partnership with MassHire for the Cape Cod and the Islands for helping us do the outreach for this session, as well as promoting the recording. And more importantly, I would like to thank the Cape Cod Foundation, who sponsored this and the series of webinars that we've done over the winter with a very generous grant. If you missed our other sessions, you can find them on YouTube. I believe there's a link to the YouTube channel on MassHire. Those other sessions included information about consolidating or refinancing student loans, as well as an overall session on how to manage repayment. That session in particular will be particularly important if the current COVID repayment waivers they're due to expire May 1st. I personally think they are going to extend them again, but if they don't, that session on understanding how to manage your loans during financial instability will be particularly important. So, this Public Service Loan Forgiveness webinar is a very popular one. We've been doing a lot of them lately, understandably so. It's pretty jam-packed with information. I tell you that to give you a warning that, especially with questions, there's a strong possibility we may go over the hour. I won't be offended if you have to drop off at the hour mark. Remember, this recording will also be on the YouTube channel. Usually we can usually get that up there within a couple days. So I wanted to tell you a little bit about me. As I mentioned, my name is Betsy Mayotte. I am the president and founder of a nonprofit called the Institute of Student Loan Advisors. TSLA's mission, its reason for being, is to provide free, expert, and unbiased student loan advice to all consumers. So anyone can go to our website. It's I would like to think it's very complete as far as especially federal student loan information and how to manage those loans. And more importantly, it's in plain English. You're not required to register. You won't be barraged with advertisements and so on. If you have questions beyond what you see on the website, you can go to our contact page and email us through our TSLA email, and we're happy to provide free counseling and even dispute resolution as needed. We answer most, probably 99.9% of our emails within a business day. My background, I've been in the student loan industry, it feels like since the earth cooled, but almost 25 years. I spent the majority of my career before I founded TSLA as a compliance officer at a nonprofit student loan guarantee agency. I've been heavily involved in the policy and advocacy side of student loans for most of my career. I was a negotiator for several negotiated rulemaking sessions with the Department of Education, and participated in all of them since back to 1999. All right, so understanding the PSLF rules, especially with the waivers, I'm gonna be candid, can be very confusing. So the way I've chosen to go about this is I'm going to explain the traditional PSLF rules first, meaning the rules that existed prior to October of 2021 when they announced the temporary waivers. And these same rules are going to be in effect after October of 2022 when the waivers end. And some of them are still in effect even during the waivers. Once I go through the traditional PSLF rules, then I'll get into the waivers. And I'm going to try to be super, super clear which rules apply all the time, even with the waivers, and which ones only apply to the temporary waivers and which ones only apply to the traditional PSLF rules. For that reason, you guys are going to get really sick of hearing me say the word traditional. But again, it's just, I want to make it as clear as possible what applies now, what used to apply, and what's going to apply going forward. Okay, so let's dive into the traditional PSLF rules. Now, there's a lot of people that say that PSLF, even without the waivers, is very difficult to obtain, and it's a confusing program. If you take a step back and really look at the core requirements for PSLF, it actually isn't. It's actually pretty straightforward. If you were only going to remember one slide from this entire presentation, this is the slide I would want you to remember, because this slide is going to allow you to answer 98% of any question you'd ever have about traditional public service loan forgiveness rules. And that is, in order to qualify for PSLF, you need to make 120 eligible payments, and we're going to define what that is, on an eligible loan while working for an eligible employer. And the key here is that all three of these things have to happen at exactly the same time. Now, they don't have to be consecutive. You could make 60 PSLF eligible payments and then take a break. Maybe you go into private sector for a minute, or you become less than full-time because you decide to be a stay-at-home parent, or you go back to school. Those 60 payments will still be waiting for you once you resume making eligible payments later on. But again, the key here is that all three of these things have to happen at the same time. So you could be on an eligible payment plan and making a payment on an eligible loan, but if you're not working for an eligible employer at the time, that month is never going to count for you for PSLF. To use another example, you could be working for an eligible employer and be on an eligible plan, but under traditional rules, if the loan you were making the payment on wasn't eligible, then that payment's never going to be able to count. So again, if you only remember one thing, this is the slide I want you to remember. You have to make 120 eligible payments on eligible loans while working for an eligible employer. So with that done, let's define all those eligibles. An eligible loan, the short answer is a federal direct student loan. Now, the Federal Direct Student Loan Program contains subsidized and unsubsidized Stafford loans, Graduate Plus, Parent Plus, and direct loan consolidations. Any of those and all of those are potentially eligible for public service loan forgiveness. It does not matter when the loan was made. They started making direct loans back in 1994. Where it gets confusing is that up until 2010, there were two primary federal student loan programs, and they were both exactly the same except where they were different. They both had Stafford loans, they both had Grad Plus loans, they both had Parent Plus, and they both had consolidation. So if you took your loans out prior to July 1st, 2010, it could be either a direct loan, which again is an eligible loan, or a federal family education loan program loan, which in and of itself is under traditional rules is not an eligible loan. If you aren't sure whether you have a direct loan or a FFEL loan, the first thing to do is figure out when the loan was taken out. If it was on or after July 1st, 2010, it's a direct loan. If it was taken out on or after July 1st, 2010, and it's a Stafford Plus or consolidation loan, then it's absolutely a direct loan and you don't have to do any more digging. If it was taken out prior to 2010, there's a couple ways you can figure out whether it's a direct loan or a FFEL. The easiest way is to call your servicer and ask them. If you don't want to do that, you can log into the Department of Education's website, which is studentaid.gov, and I do have that listed at the end of this presentation. All the websites I mentioned are mentioned at the end of this are listed at the end of this presentation. You could log into studentaid.gov and look at the loan detail. And if it's under the lender, if it shows Department of Education, then it's a direct loan. It's not a FFEL. Now, if you do have a FFEL loan, all isn't lost. While under traditional rules, FFEL loans are not eligible for PSLF, you can consolidate them into the direct loan program, at which point they become eligible for PSLF because now they're direct loans. To do that, you would consolidate at studentaid.gov. It's free to do it, and the form is actually fairly straightforward. You can also do that with other federal student loans, federal nursing loans, federal Perkins loans. If you happen to have the old HEAL loans, loans for disadvantaged students, etc., any of the loans you see on this list in front of you can be consolidated into the direct loan program, and at which point they become eligible for PSLF under traditional rules. Now, under traditional rules, it's important to know that any payment made on a FFEL or Perkins or HEAL loan is not going to be eligible for PSLF, and any payments made prior to consolidation are not going to be eligible for PSLF. Under traditional PSLF rules, if you consolidate, your PSLF count is set to 0, even if some of the loans that you consolidated were direct loans to begin with. Now, you're going to see when we get to the waiver that the fact that consolidation resets the counts is one of the big things that they're lifting that rule during this temporary waiver. But if you consolidate after the temporary waiver is over, it's important to know that your PSLF count will reset to 0. Now, if you have a private loan, and by private, sometimes people these days are calling FEL loans private loans. They're not. They're federal loans that just happen to be held by a private lender. By a private loan, I mean something that's not a Stafford loan or a PLUS loan. For example, Discover makes a lot of private loans. Citizens Bank, Sallie Mae has private loan programs. Private loans can never be eligible for PSLF, even if they're made up of federal loans that you refinanced into the private loan program. Unfortunately, there's no take-backsies there. And so once it's a private loan, it's always a private loan and therefore not eligible for PSLF. Other non-federal loans are also excluded from PSLF. That includes state loans. So for example, here in Massachusetts, we have the Mass No Interest Loan. Loans taken out directly from your institution. Anything other than a direct loan is not eligible for PSLF. Before we get into what an eligible employer is, are there any questions? And you can throw them up into the chat panel. Are there any questions about what an eligible loan is under traditional PSLF rules? Okay. All right, I'll check in again on the questions in a little bit. So, all right, so now we know what an eligible loan is, which is a federal direct loan. Now let's talk about what eligible employment is. Now, the definition of eligible employment for PSLF is one of the big myths that is out there for our student loan consumers. The fact of the matter is, it actually doesn't matter what you do for a living. It doesn't matter what your title is. It doesn't matter what your day-to-day responsibilities are. What matters is who you work for. You have to, if you work for an eligible employer, which we're going to define what that is in a minute, you 100% are working eligible employment. Now, you do have to be full-time, and full-time is defined by your employer, or you can work part-time for multiple eligible employers as long as you're working at least 30 hours per week. Now, this is another place where sometimes I see consumers trip up. If you do have to be working full-time as defined by your employer, that 30-hour-a-week minimum is, and it also has to be at least 30 hours a week. So for example, if your employer defined full-time as 40 hours a week and you were working 35 and you were only working for that one employer, that would not count as eligible employment. Now, in that scenario, if you were to pick up just one more hour at another eligible employer, so now you're working 36 hours a week for multiple eligible employers, 36 is more than 30, then that would count. But again, you have to be, if you're only working for one employer, it has to be full-time as defined by that employer. Where I see this come into play often is unfortunately with adjunct professors at colleges and universities. I have recently learned, well, since I started working with people closely on PSLF, that the majority of colleges and universities do not consider adjunct professors full-time, regardless of how many hours a week they work. And unfortunately, because of that, because the schools won't certify them as full-time, even if they're working 40 hours a week, they can't count that employment as eligible employment for PSLF purposes. Now, if you happen to be one of those people that falls into that unfortunate situation, I can tell you that rule might be changing by the end of this year, but as of right now, that is what the rule is under both traditional PSLF rules as well as the waivers. Now, the best way, even though I'm going to tell you what an eligible employer is in the next slide, the best way to verify whether your employment is eligible is to submit the public service loan forgiveness form. There used to be a separate form to verify employment versus apply for forgiveness. That's no longer the case. It's all wrapped up in a single form now. The old form was called the Employment Certification Form in the ECF. And to try to keep things clear, I'm going to continue to use that term, but just know there is only one form. And that form can be found at studentaid.gov. I can't recommend strongly enough that people get in the habit of submitting their proof of employment on an annual basis. And this is for a couple reasons. Number one, submitting the form is the only way to know 1,000% sure that your employment is actually eligible. Number two, once you submit the form, they're going to bring your loans over to whomever the PSLF servicer is. Right now, that's Fed Loan Servicing, but by 2023, it's going to be MOHELA, and they're going to start counting your eligible payments. And that's the only way to make sure that you have the right loans and you're on the right repayment plan. So really, the best way to know that you're on track is to get in the habit of submitting that employment certification form. The last reason is because that, up until 4 or 5 years ago, a lot of companies kept records for a really, really long time. But these days, it is recommended from an information security as well as a legal liability standpoint that organizations get rid and destroy records as soon as it makes sense to do so. And that could mean that if you go back to a prior employer that you worked for, say, 10 years ago, it's not impossible. And in fact, I've seen it happen more than once where they refuse to sign off on the employment certification form because they no longer have records of your employment. And then you're kind of stuck. You don't really have a way to prove that employment in most cases. So for that reason, again, I strongly recommend that you get in the habit of submitting your proof of eligible employment on an annual basis. All right. Excuse me. Let's talk about what an eligible employer is. An eligible employer is any government employer. That's federal, state, local, or tribal. Full stop. You work for a government employer full-time, you are working eligible employment. Now, by the way, that includes if you're serving full-time in the military, Peace Corps, or AmeriCorps. Now, if you're a contractor for the government, that probably is not going to qualify. Most contractors are for-profits, and for-profits can never count for PSLF. So it could be this scenario, and I see this all the time too, where, every day you walk into a government building, you sit at a government desk, you answer a government phone. But because you're not a direct employee of the government, you are not considered a government employee, and therefore, unless the contracting company itself is an eligible employer, which again is rare, it's not going to be considered eligible employment. And this applies even both for traditional PSLF as well as under the waivers. Now, going back to the whole, it doesn't matter what you do for a living, it matters who you work for. I see this often, especially in the public school system. So for example, most teachers that work for a public school are aware that they're potentially eligible for PSLF because they're working for the city of Mashpee or the city of Boston, for example, or the city of Plymouth, who is often not aware that they also are potentially eligible for PSLF is everybody else who works at that public school. Cafeteria workers, custodians, administrative assistants, the gym teacher, the principal for that matter. Because they are considered city employees at that public school, they are just as eligible for PSLF as the actual teachers are. Another type of eligible employer is any 501c3 nonprofit. If you work for a government employer or a 501c3 nonprofit, you are working for an eligible employer, full stop. Where it gets a little trickier is if you work for a nonprofit that's not a 501c3. Those can be eligible, but only if their primary reason for being is one of the bullet points you see in front of you, such as public service for individuals with disabilities, public education, school library or other school-based services, law enforcement. What makes it even trickier is that a lot of these bullet points are not as forthcoming as they appear to be. Most of them have definitions behind them that may not come to mind when you first read the bullet point. So, for example, public interest law services, that's the way it's listed in the public service loan forgiveness regulations, is that a nonprofit whose primary purpose for being is public interest law would qualify. However, if you look at the definition of public interest law, what you'll see is that it's defined as an organization that receives at least part of its funding from the government. So again, if you work for a nonprofit that's not a 501c3, if I didn't already convince you on the prior slide how important it is to submit your employment certification form on a regular basis, if you work for one of these nonprofits that's not a 501c3, it's even more important, because the only way you're ever going to really know that they qualify is to get that approval once you submit the employment certification. Now, there is something called the Pslf Tool, and that's located at studentaid.gov. It's strongly recommended that you get your employment certification form filled out through the Pslf Tool, and that's for a couple reasons. First of all, the Pslf Tool, and this is a fairly recent development, they've since bumped it up against the database of all the employers that the Department of Education has already vetted and blessed as approved employers. So if you go through the Pslf Tool, you should be able to get, if someone before you has already submitted your employer under Pslf and it's already been vetted, you should be able to know right away if it's already an approved employer. Now, if it isn't already in the database, that's okay. It just means that your application will take a little bit or maybe a lot longer than the others, because it has to go through the initial vetting process at the Department of Ed. They had a really big backlog for those. Last I heard, which was a few months ago, they had a backlog of about 10,000 new employers, and there was only like 1 or 2 people at the Department of Ed that was vetting them. I do know for a fact that they've since hired an additional 5 people to get through that list. So hopefully it won't take as long, but it was taking as long as 6 months, just to give you a general idea of when to worry and when not to worry. So again, even if your employer isn't already in the database and doesn't show up when you fill out the form with the Pslf Tool, that's okay. You should still submit it. It'll just have to go through the vetting process. Now, a couple things to remember. In order to be eligible for Pslf, you have to be working full-time for an eligible employer, or at least 30 hours a week for multiple eligible employers at the time you make every single one of those 120 payment of your Pslf eligible payments. And that applies for both traditional Pslf as well as the waivers. You also have to be working for eligible employment at the time you apply for forgiveness and at the time that the government reviews your forgiveness application for approval. Now, those 2 bullet points are waived during the temporary waiver, but unless they make some additional changes, which I'm not necessarily expecting in this area, if you're not due for forgiveness until after October 2022, you do want to make sure that you are still working for an eligible employer at the time you apply for forgiveness, and wait until you get that magic letter in the mail showing your loans have been forgiven before you decide to quit or retire. Now, you don't have to work for the same employer for all 120 payments. You don't have to work consecutive eligible employment, and you don't have to have consecutive eligible payments. As I mentioned before, and that's both for traditional Pslf as well as the waivers. Now, as I mentioned before, these things don't have to be consecutive, and they'll still be waiting for you if you take a break for whatever reason from accruing Pslf eligible payments. Those payments will still be waiting for you as long as you don't consolidate. Again, that consolidation reset piece is waived until October 2022, but after that, if you consolidate, it will reset the count. All right, so we know what an eligible loan is. It's a federal direct loan. We know what eligible employment is. It's working full-time for either a government employer, a 501c3 nonprofit, or another nonprofit that whose primary reason for being fits one of those bullet points that you saw in front of you. Before we get into what an eligible payment is, I'm going to check the chat real quick and see what questions we have. So somebody asked, can you submit pay stubs or a W-2? If you submit pay stubs or a W-2 as proof of employment, they're gonna want to contact your employer to verify that you did actually fulfill the employment requirement. The problem is W-2s don't show whether you're considered full-time or not, and most pay stubs don't either. So you do still have to submit the form. There is a box on the form that says my employer refuses to certify. And if you check that box, then either the Department of Education or the PSLF servicer will reach out to the employer and try to verify your employment for you. Now, if you're asking about the pay stubs or W-2 because the employer is closed and doesn't exist anymore, it's possible that the state may have, you might want to do a little digging and see if whoever took the company over has the records, or if the state might have the records. But otherwise, you can try submitting the W-2s, but you might be out of luck, I'm afraid, which again is all the more reason to get in the habit of submitting the proof of employment on an annual basis. Someone else asked if I could repeat what I said about if you consolidate. I think I did repeat that a couple times, but just in case, if outside of the temporary waiver, if you consolidate your loans, if you had any PSLF eligible payments already under your belt, those are going to go away. When you consolidate, it'll reset your account to 0. But as you'll see under this temporary waiver, consolidation actually, and for this period only, consolidation will not reset your account to 0. Okay, let's talk about an eligible payment. Now, an eligible payment has to be made on time, and this is traditional PSLF rules. And on time is defined as within 15 days of the due date. Now, in the past, you could not make, lump sum payments didn't count, but they have in the past 3 years or so changed that rule. You actually now can make a lump sum payment and have it potentially count towards PSLF payments on a limited basis. So for example, if your payment was $100 a month, and in January you made a payment of $1,200, assuming that you continued to work eligible employment for the next 12 months, they would count $100 a month for the next 12 months. Or until your next income-driven plan renewal date, whichever is soonest. So using my same example, your payment's $100 a month. In January, you send in $1,200. That could count through December, but if, say, your income-driven plan renewal date was June, they will only count through June. And again, they won't count at all until you submit proof that you worked eligible employment for that period. And of course, you can't prove the future. So, you know, when they first changed this rule, I had some consumers get really excited because they thought they could get PSLFs earlier. And that's not the case, because again, you still have to have been working eligible employment during those months, and you can't prove that you worked eligible employment until you actually worked it. So to be clear, there are 0 ways to get PSLF in less than 10 years or 120 months. Who this lump sum payment rule change really benefits are people that are lucky enough to work for, say, an employer who has some sort of student loan repayment program. Often these payments are sent on an annual or biannual or quarterly basis. And before they changed the rule, what was happening is an employer would submit a lump sum payment on a quarterly basis, and that was the equivalent of 4 or 5 months of payments. And those poor borrowers were still having to pay every single month because lump sum payments didn't count. So now in that scenario, the lump sum payment can count at least on a limited basis, as I explained a second ago. Now, in order to be an eligible payment, it has to be made under an eligible repayment plan. That is any income-driven repayment plan or a 10-year standard plan. Now, the standard plan is where another place where consumers tripped up. And to be fair, up until, at least initially, it was not their fault. We know that when PSLF was first written into law in October of 2007, and for the next at least few years, there was at least one servicer that was incorrectly telling borrowers that any standard plan counted for PSLF, and that's just not the case. Under the law, only an income-driven plan or a 10-year standard plan counts. Now, if you consolidate your loans and you don't pick a different repayment plan, they're going to put you in something called a standard plan. The problem is that it's going to be a standard plan based on between 12 and 30 years rather than 10 years. So there were a lot of people under the standard consolidation plan that thought they were skipping happily along towards PSLF forgiveness when it turns out that the standard consolidation plan didn't count. The graduated repayment plan, which is a plan that starts off as interest only, also doesn't count for PSLF under traditional rules, nor does the extended repayment plan. Now, in 2018, Congress recognized that incorrect information was given out, and they created what's called the TEPSLF. Now, the TEPSLF does allow for other plans, such as consolidation standard plan, graduated or extended. The temporary waiver does as well. But traditional PS, and we're going to talk more about the TEPSLF in a few minutes. But for traditional PSLF rules, you need to be on an income-driven plan or the 10-year standard. Now, if you're someone that's not going to hit forgiveness before the temporary waivers are over in October of 2022, you're going to either need to get on an income-driven plan or determine if the TEPSLF makes sense for you to pursue instead. Only payments made on or after October 1st, 2007 count. Payments made while in default can never count. You do have to be working full-time for an eligible employer at the time you make every single one of those payments. That's under traditional rules as well as the waivers. The payment has to be made on a direct loan. Now, it doesn't matter who makes the payment. So using that employer example, those payments would count even though they were made by your employer rather than yourself. A more common example is families with Parent Plus loans. Now, the Parent Plus loans are in the name of either mom or dad, but a lot of families have an arrangement where the student is the one actually making the payments. That's fine too, as long as it's the parent borrower who is working for the eligible employer. So let's say the Parent Plus loans were in mom's name and Junior was the one making the payments. It has to be mom that's working for eligible employment in order to qualify for PSLF. Doesn't matter that whether it's mom or Junior or employer or Santa Claus that's making the payments. Now, just to expand a little bit more on an eligible payment plan, as I mentioned, the 10-year standard plan is an eligible plan, but that's kind of a trick because if you make 120 payments under a 10-year standard plan, you're going to pay the loan off. But again, you don't have to be on the same plan for every one of those 120 payments. Income-based repayment or IBR. Now, there's two IBRs, and they're both exactly the same except where they were different. We call them old IBR and new IBR. Both of those count for PSLF as long as the payments were made on a direct loan. Pay-as-you-earn program, revised pay-as-you-earn, and income contingent repayment. Now, a word about Parent Plus loans. Now, as I mentioned, Parent Plus loans are 100% eligible for PSLF. However, it's a catch-22, and a mean one at that. Parent Plus loans are not eligible for any of the income-driven plans as they stand. Now, as I mentioned before, if you make 120 payments under a 10-year standard plan, you're going to pay the loan off. So why would they allow Parent Plus loans to qualify for PSLF if they can't really benefit from it? Well, there is a loophole. I'm calling it a loophole, but it's not really a loophole because it's known. If you consolidate the Parent Plus loans, which again, you would do at studentaid.gov, the loan then becomes eligible for what's called income contingent repayment and ICR only. So if you're a Parent Plus borrower who is potentially eligible for PSLF, you have to consolidate in order to really benefit from this program, because you need to get on ICR in order to potentially get a lower payment and benefit from it. Now, again, you don't have to be on the same plan for all 120 payments, and these plans only count if they're made on a direct loan. Now, ICR, Revised Pay-As-You-Earn, and Pay-As-You-Earn, and new IBR, you can only get if you have a direct loan anyway. Old IBR, you can get if you have a FEL loan, but the rest you can't get unless you have a direct loan anyway. Okay, so we know what an eligible loan is. It's a direct loan. We know what eligible employment is. It's full-time employment for a government employer, a 501c3, or another nonprofit that happens to meet the other criteria. And we know what an eligible payment is. It's one made on an eligible plan, which is any income-driven plan, or the 10-year standard, while working full-time for eligible employment, and that's made on a direct loan, and that's made on time. And that's all under traditional rules. Before I get into the TEPSLF and the COVID waivers, and of course, the temporary PSLF waivers, are there any questions about the traditional public service loan forgiveness rules? Okay, let's keep going. All right, the TEPSLF. So I've already sort of mentioned the TEPSLF. This was put into place by Congress in 2018 to try to fix the errors that had been, the incorrect information that had been given out to borrowers prior to that. Now, the bottom line is this: the only thing that the TEPSLF waives is the payment plan. You still have to have a direct loan. The definition of eligible loan doesn't change. The definition of eligible employment doesn't change. The fact that the payments have to be made on time doesn't change. What does change is that payments made under a graduated repayment plan, extended, or the standard consolidation plan also count. Now, they awarded a limited amount of money for the TEPSLF, and it's first come, first serve. They awarded $750 million. Now, the good news is that because of the current temporary waivers, that fund is going to be depleted a little bit slower. But if you've been on the wrong plan and you still have, say, 5 years to go, I would not count on necessarily there still being funding under the TEPSLF once you finally hit payment 120. There could be, but I wouldn't put all my eggs in that basket if I were you. If you only have a year or two, I feel pretty confident that there will. I would feel actually very confident that there will still be money in that fund a year or two from now. And if it makes sense to stay on the TEPSLF track, that's what you should do. Now, where it gets squirrely is the last sort of the other difference with the TEPSLF. So while any plan counts, your 12th to last and last payment have to be at least as much as you would have paid under an income-driven plan. Now, when they came out with this overly confusing, wonky-looking rule, I reached out to some congressional staffers and said, why did you do this? And it was as I suspected. This wasn't actually the intent, but it was a case of too many cooks spoiled the soup, but this is what we ended up with. So if it turns out, so let's say you've been on the standard consolidation plan, and you take a look at what your lowest payment would be under any of the income-driven plans, and that payment is lower than what you've been paying. Well, the easiest thing to do, and the thing that makes the most sense, is get on an income-driven plan and make that payment for your last 12 payments. If there are a lot of people, however, that their lowest income-driven plan is a lot higher than what they've been paying on, say, the standard consolidation or extended repayment, that's the scenario where you'd want to go the hard way, go the math way, so to speak. And what you would do is for your 12th to last payment, you'd figure out what your income-driven plan amount would be, send in that amount for the next 10 payments. pay what you have been paying, and then for your 120th payment, do that math exercise all over again. If this is going to end up applying to you, you can take a look at our website at the bottom of the PSLF page. We go into a little more detail with some examples. And the other thing to note is that if you happen to hit the 12th to last payment under the TEPSLF, now remember, you don't have to worry about this for the traditional PSLF rules or for the temporary waivers for that matter. It's only people that aren't going to hit 120 until after October 2022 and who haven't been on an income-driven plan and don't want to get on an income-driven plan that this would apply to. But like I said, you can read about it in more detail on our website. All right, so let's talk about how you apply for traditional PSLF or the TEPSLF for that matter. Once you've submitted proof of 10 years of eligible employment, the first time you submit, as I mentioned, they're going to move your loans over to whomever the PSLF servicer is. Right now, it's Fed Loan Servicing. By 2023, by the end of 2023, it's going to be Mohila. They will then start counting your eligible payments. Under traditional PSLF rules, once you hit payment 120, you have to submit an application for forgiveness. Now, again, this is all one form. So the difference matters which box you check. There's a box that says, hey, I think I made it, check me out. And if you check that box, they're going to put your account temporarily in forbearance while they review it, and you won't have to make another payment. If you check the box that says, I just want to know where I'm at, they're not going to put your account in forbearance. But if you happen to hit 120 when they review it, they'll still forgive it. Any payments you've made over 120 will be refunded to you, as long as those payments, if you did consolidate along the way, as long as those overpayments were made after the consolidation. So for example, if you made, say, 20 PSLF eligible payments prior to consolidation, and then you've made 100 payments since consolidation, there's not going to be a refund. But if you made another 120 under the temporary waivers, at least, that means they will have counted 140, and you would end up getting a refund of the additional 20 payments. All right, so the COVID waivers. So all direct loans and a very tiny portion of FEL and Perkins since March 13th of 2020 and through May 1st of 2022 have not been due any payments. They're also been enjoying a 0% interest rate. That period of time counts towards PSLF, traditional and the waivers, as well as the TEPSLF, as long as you were still working for eligible employment at the time. Now, there were some people, especially in the beginning, who thought this sounded too good to be true, and they were terrified about screwing up their PSLF, so they've been making payments anyway during COVID. If you're one of those people, and you are pretty confident at this point that you are going to get forgiveness under PSLF, stop it. Not only stop it, but once you get off this webinar, I want you to call your loan servicer and ask for a refund of all those payments back to March 13th. The reason for that is these COVID months count, full stop. As long as you were working for eligible employment, they're going to count for PSLF and the TEPSLF. Waivers and no waivers. Paying during this period, you can never get credit for more than 1 month in a month. So continuing to make payments during COVID is the equivalent of going to the ATM, taking the money out, going home, putting it in your fire pit, lighting it on fire, and roasting marshmallows over it. It will not get you PSLF any quicker, and it's literally throwing money away. Even if you're not sure if you're going to get forgiveness under PSLF at this point, if you think there's a possibility, I would still ask for that refund and just bank it. All right, now let's get into the waivers. I don't see any questions about anything I've talked about under traditional PSLF rules or the TEPSLF. I am happy to hang out after I'm done with this, though, if there are additional questions. Okay, let's get into the fun stuff. So On October 6, 2021, the Department of Education made an announcement that they were going to offer these temporary PSLF waivers. Now, believe it or not, we can actually thank COVID for this, because if it wasn't for the pandemic, the Department of Education, and more importantly, the White House, would not have the authority to do this. The White House nor the Department of Education has the authority to do anything that's contrary to federal statute. And most of what they're doing under this waiver is required under federal law. So it's only Congress that can change it with a new law. But that's also the other reason why there is a hard stop to this October of 2022. If you don't do what you need to do to qualify under the waivers by October 2022, there isn't a person on the planet that's going to be able to help you. There can be no exceptions because, again, the authority for this waiver will have run out. Now, it's possible that authority could get extended. We don't know what's going to happen with the variants and the national emergency and so on. But at this point, I am an optimist from a pandemic perspective, at least, and I don't see this getting extended past October of 2022. So I can't say this more emphatically. Not your congressman, not me, not the Secretary of Education, not the President of the United States will be able to make an exception for you if you don't do, if you have to take steps to qualify for this waiver and don't do it by October of 2022. So here's what those temporary exceptions are. Payments made on a FFEL loan or a Perkins loan, or payments made prior to consolidation now count, but only under this temporary waiver. Now, this doesn't apply to periods of default, and for no reason that I've asked 100 times and I've not been given a good answer, and I'm very salty about it. Unfortunately, it doesn't apply to Parent Plus loans. But let's go back to the good news part of it. So let's say you have FFEL or Perkins, and you've been making payments on those for the past 10 or 20 years. If you consolidated those loans before October 2022, and you were working eligible employment during summer, all of that period, they're going to count all of those months towards PSLF. But you have to make sure it's a direct loan before October 2022 and submit proof of at least one period of eligible employment before October 2022 for it to count. Now, if you've already consolidated your FFEL loans, say 3 years ago, and you've already submitted proof of eligible employment, you don't have to do anything. They will still count your pre-consolidation payments under the waiver. You just have to make sure that if you haven't already, that you submit proof of eligible employment for those repayment periods. Now, there is a little bit of a loophole for Parent Plus loans. Unfortunately, it doesn't apply to that as many Parent Plus borrowers as I would like it to. But if you're, and I guess I'll air quote this, lucky enough to have Parent Plus loans in your name, but you also have Stafford and or Perkins and or Graduate Plus loans in your name from your own education that you haven't finished paying off yet, if you consolidate those together with the Parent Plus, they will count the periods of eligible repayment on the non-Parent Plus loan towards the whole consolidation. So for example, if you have Parent Plus loans and you also have Stafford loans from your own education, and you've been working for an eligible employer, and your Parent Plus loans have 40 PSLF eligible payments under them, but your Stafford loans have 90 eligible payments under them. If you consolidate them together, the final consolidation will be given credit for the 90. But if you have Parent Plus loans and you had some eligible payments before because you were on a 10-year standard plan, and then you consolidated them to get access to ICR, unfortunately, they're not going to count those pre-consolidation payments for you because they were made on a Parent Plus. There's still a tiny chance they'll change their mind on this, but this far into the waiver, I don't have high hopes that they will. And again, I don't know why they excluded them. Now, they're going to count these months even if the payment was delinquent or short, all payment plans count. So what doesn't count are any periods that you were in deferment, or you were in school, or you were in a forbearance. The exception being if you were in a deferment or forbearance because you were full-time in the military. So to be clear, they're counting every single month that a loan was just in a repayment status. Doesn't matter what you paid or when you paid or under what plan you paid or under what loan type you paid under, back to October 2007 for any month that you were working full-time for eligible employment. You do not need to gather your past repayment histories. You don't have to gather your past bank records. You don't have to ask for a FOIA to be able to prove you made payments. They're not even going to look at that stuff. What they're looking at is, so since the dawn of time, any federal student loan holder has been required on at least a monthly basis. It's more frequent now. Now it's like a weekly or bi-weekly basis. Has been required to submit to the Department of Education for every loan they held, the loan balance, as well as the status of the loan. Is it in repayment? Is it in forbearance? Is it in default? And that's what the Department of Education is using under this waiver. So if you want to get a general idea of how many months in repayment you might already have, because you've consolidated in the past, or you've taken deferment or forbearance in the past, you can go to studentaid.gov and expand out the loan detail for each loan, and it'll show you the months that each loan was in each status. Now, back when direct loans started, there was a single direct loan servicer, and that servicer changed names a bunch of times, but it was called the direct loan servicer. It was called ACS. It was called Conduit. It was bought by Xerox, so some people called it Xerox for a while. They are no longer in the student loan servicing game, and that is for good reason. And it is a known issue that they did not always report correctly. Like, for example, there's a lot of borrowers that if you go to studentaid.gov and look at the account, it'll show that you had a 2-year grace period back when you were with ACS. There's no such thing as a 2-year grace period. Stafford loans get 6-month grace periods. Perkins loans get 9 months. It is impossible to have a 2-year grace period. So this is one of the things that the Department of Ed is trying to solve under this waiver. And so they're automatically, if you're one of those people that's showing a 2-year grace period, they're going to give you 18 months of that 24 months and assume that you were in repayment. And if you submit proof of employment for that period, eligible employment for that period, they're going to give you credit for those 18 months. We also know there's missing servicer history. The Department of Ed is doing what they can to resolve that as well. And it looks like that they are resolving a lot of these in the borrower's favor. So again, there's no need for you. There is very, very unlikely going to be a need for you to have to prove that you made payments during any of these periods, because the Department of Ed is using the data that they have on hand, which is a much higher level data. Something else they're doing under this waiver is usually you cannot double dip forgiveness programs. So there's a program called Teacher Loan Forgiveness where if you worked 5 consecutive years for a Title I school and you're considered a highly qualified teacher, you can get between $5,000 and $17,500 forgiven from your loans. The problem is that if you then wanted to pursue PSLF, you had to do a whole other 10 years. You couldn't count the 5 years that you used for teacher loan forgiveness towards public service loan forgiveness. During this temporary waiver, during this waiver only, they are going to allow that double dip. So if you're someone that has used 5 years for teacher loan forgiveness, I strongly recommend that you submit a PSLF proof of eligible employment for those 5 years right away so you can get credit for it under the waiver. Now, another piece of this waiver, and we can thank our Attorney General's office as well as the American Federation for Teachers for this, the Department of Education and Fed Loan Servicing are being required to go back and look at every single PSLF account that they have on file to date. and that includes ones that they've denied in the past. So if you already have all direct loans and you already have submitted proof of eligible employment, you don't have to do anything. They're going to get to you if they haven't already. And they are going to review your account. So you don't have to do anything. You don't have to call them. In fact, please don't call them. Their call volume, because of the waivers, we're already looking at an average of 2.5 and 3 hour wait times. And calling will not get your account to move or get reviewed any quicker. But again, they will review your account automatically under this waiver if you already have all direct loans and have already submitted proof of eligible employment. So just to reiterate, in order to qualify for the waivers, if you have FFEL loans or Perkins or other ineligible loans, you have to consolidate by October 31st, 2022 in order for any pre-consolidation payments to count. You also have to submit proof of at least one period of eligible employment before October 2022 in order to get it counted under the waiver. Now, you don't have to be at 120 payments by October 2022. If, let's say, you had FFEL loans today, and thanks to this awesome webinar, tomorrow you consolidated them and ended up with 60 eligible payments under your belt. Those 60 will stay, will still be available to you after October 2022. So you don't have to hit 120 payments by then. You just have to have put all your ducks in a row for the waiver by October 2022. You do have to, as I've mentioned before, but it bears repeating, what hasn't changed is you have to be working for an eligible employer during every single one of these repayment months. But you don't have to be working for an eligible employer at the time you apply for forgiveness, if you're applying if you hit 120 during the waiver, or when they review your account. So for example, and this is a real life example, I have a borrower that retired 2 years ago. But before he retired, he'd accrued 120 payments while working for an eligible employer. It was just on a FFEL loan, which is why he never did anything about it. So he's under the waiver, he can consolidate, and they're going to give him forgiveness. The other thing that's different under the waiver is you don't actually have to apply for forgiveness. Once you hit 120, they're just going to give it to you. And the way it's happening for most people is they just log into their account one day and they show a zero balance, or they try to log in on their phone with the app and they're told that they can't, that they don't have access under the app. Where it gets confusing and causes anxiety is, unfortunately, the communications under the waiver are not, I'm going to put this as nicely as possible, ideal. I do know that they're, within the next couple of weeks, they're coming out with new communications that hopefully will ameliorate this. But as of right now, what's been happening is some people got an email from the Department of Education back in the fall that said, we estimate your payment count's going to go up by X number of payments. Just sit tight. So people sat tight. Some people took action as needed. And then you don't hear anything. You don't hear confirmation that they received your application. You just don't hear anything. And then meanwhile, you see people around you on social media saying, hey, I got my loans forgiven. Or, I already heard back. And maybe they submitted their application months after you did. And that causes anxiety. And then to make matters worse, then you finally get a letter in the mail. And the letter says, we've reviewed your account under the waivers and you have 50 payments, when you know that at least under the waivers, you should have 100 payments. Don't worry about it. The waiver's going in phases. And the first phase is that Fed Loans is reviewing the account, and they're using the data that they have in their own database. And then sometime after that, the Department of Education is sending over their data, which is the more complete data under the waiver. And then the account gets reviewed again. And that's when you end up with that final count. So this process is taking anywhere from weeks to months. They have 1 million accounts to look at. There is no algorithm for in what order they're looking at this account. There's some vague, like they were trying to get the people that might have already hit 120 first. But other than that, they're like, as I've said before, when talking to people about this, don't waste your time trying to Da Vinci code this thing, because there is no algorithm for it. And again, calling, filing a complaint, contacting your congressman is not going to get your account reviewed any faster. To be frank, no one borrower is more important than another. So even though you feel like you've been waiting longer than other people, I promise you they will get to you. Now, at the end of April, they're developing what they're calling a new reconsideration process. If after you get your final count, you still think it's wrong, and you think it's wrong because you think they counted wrong, not because you don't like the rules. The reconsideration process is not going to get them to change their mind on the rules. But if you think the count is wrong, then you'll be able to submit an appeal via this reconsideration process, which again, I think the target date for that is April 22nd. But somewhere towards the end of April, they're going to have this reconsideration process available. Before I hit these talking point reminders, I am unashamedly, I can't find my words. I want to put you guys down the same rabbit hole I went down when I was putting this presentation together. I don't want to date myself, but when I saw this picture, I was a little shocked, is probably an overdramatic word, because I never remembered the count having facial hair. So I went down a Google rabbit hole to find a picture of the count from back when I used to watch Sesame Street to determine whether or not this was a new look for him or if he's always had it. And I will tell you what the answer to that is when we're done. But I suspect some of you will go. So if you think he's always had facial hair, or if you think this is a change, you can put your thoughts in the chat panel. Anyway, just to reiterate, the following rules are temporary exceptions. The fact that consolidation will not reset the forgiveness count. Now, by the way, if you do go to consolidate, you're still going to get a letter in the mail saying, hey, you know this is going to reset your PSLF, right? Don't worry about it. And if you don't want to take my word for it, the fact that consolidation will not reset the count during the temporary waiver, you can go to the PSLF page at studentaid.gov, the Department of Ed's website, and they'll confirm that for you. It's in writing there. If your loans have different payment counts and you consolidate them, the consolidation is going to be assigned the higher count. And it's actually more detailed than that. So let's say you have undergraduate, you went to undergrad school, you graduated, you started working for an eligible employer, then you and accrued, say, 20 PSLF payments. Then you went to grad school and took out new loans. And when you finished grad school, you again went back to working for an eligible employer. So now today, your undergrad loans have 60 payments and your graduate loans have 40. If you consolidate the two of those two loans groups together during the waiver, the final consolidation will be given credit for the 60. What they're actually doing, they're not actually giving you credit for the higher count. What they're doing is they're giving you credit for every single eligible month prior to that consolidation. And it just so happens that those undergrad loans, in my example, had 20 months credit that the graduate loans did not. Now, if the consolidation is, if you've consolidated multiple times, they will do a look back prior to every one of those consolidations. I've already sort of gone through this, that there's two phases to the review. The waiting is, I should change this picture to one of Tom Petty, because literally from what, and I get it, the waiting is the hardest part. For what it's worth, I see them doing a lot of batch updates on Tuesdays. So if you don't want to be that person that logs into their Fed loan account every single day or multiple times a day, maybe restrict yourself to Tuesdays. And what usually ends up happening is you see the zero balance before you get any type of letter or email. And if you do a refund, you sort of have to get lucky. The refund shows up as a negative balance or a balance in parentheses, but only for like a minute. So some of the borrowers I work with have been quick enough to catch it, but then it disappears. The refund comes directly from the U.S. Treasury, and if they already have your bank account information on file, because maybe you had ACH payments with Fed loans before COVID, then you will get the refund through ACH. It will come in as multiple transactions. If you're getting the equivalent of 20 payments back, you're going to get 20 transactions. If they don't have your bank account on file, then they're going to send checks. And if you have 20 payments coming back, you're going to get 20 checks. Originally, those refunds were coming in about 3 weeks. Now it's taking a little longer, 30 to 45. Some people have even gone 60 days. But again, they're coming from Treasury. The best way to know if you're getting a refund is that when you do see the forgiveness email, it will tell you the effective date of the day that they figure you hit 120. So say it was January of 2017. You want to look at your payment history and figure out how many payments you made after January of 2017. And that's the refund you're going to get back. Now, of course, if you haven't been paying during COVID, which as I said before, I hope you haven't, you're getting credit for those months, but you didn't pay anything, so there's no refund to send back to you. So that's what I had for you today. In front of you, what you have are resources. Of course, there's our website. On our PSLF page, we have, in addition to everything I just said in writing, we have a pretty extensive FAQ document that contains some case studies regarding the waivers that people have found helpful. I also recommend you check out the Department of Education's page. You go there for additional PSLF information, the Pslf Tool, that's where you go to consolidate. And this boot camp that I have on here too probably doesn't apply to most of you. It's a student loan counseling boot camp that I've created for financial planners or people that counsel consumers on their finances that want to be able to counsel on student loans. This boot camp is not for the general public. So with that said, it's 1:07. I'm sorry, not sorry for going a little bit over. Happy to hang out to answer more questions. I see, you're welcome. I'm glad you liked it. Thank you for the thank you. We're a nice, cozy group. So if you do have questions, if you don't feel like typing them out on the chat panel, feel free to just take yourself off mute and ask them. Okay, so while I'm waiting for people to type or decide if they have any questions, I'm going to get on my soapbox for just a minute. I am really worried about when this temporary waiver is over. I guarantee you that on November 1st is when I'm going to get my first email through Pslf of someone asking for help on the waiver, and there isn't going to be anything I could do about it. If you work for a PSLF eligible employer, I cannot recommend enough that you nag, cajole, beg, convince, wheedle that employer to share information about public service loan forgiveness and these waivers to the rest of the employees. It doesn't have to cost them a dime. It can be as simple as them sending an email out with the Department of Education's PSLF waiver link on it. Preferably, they would do more, such as a webinar, like what you're experiencing here. We do them quite often for employers. Or it could be something even more extensive. But it doesn't have to be. And it doesn't have to cost them a dime. In all my years of working with consumers, and we've done a ton of work on PSLF even before the waivers, I've come to the conclusion that the best path to educate and communicate PSLF information is through the PSLF eligible employers. And again, because this waiver is so valuable and like literally life-changing for some of the people that I've worked with on it, and it has such a hard stop, you would be impacting a lot of lives if you were able to convince your employer to share information with the rest of the employees. talk about it with your friends. Share the link to if you don't want to share the link to my website, share the link to the Department of Education's website. We just need to reach as many people as possible. And if you need another reason to convince your employer to support PSLF, this can be an enormously valuable recruitment and retainment tool. I am starting to work with employers that are starting to add the fact that they're a PSLF eligible employer in their job postings. And I know for a fact from the people the consumers that come to TSLA, that there are people that specifically look for PSLF eligible employers for jobs. So this is essentially a really valuable free benefit for the PSLF eligible employer. And I don't understand why more of them don't take advantage of the fact that this is a free benefit. I shouldn't say that. There's the tide's starting to change, especially government employers that haven't been able to offer raises in a couple years are starting to promote PSLF as a benefit. We just did a PSLF webinar for the city of Milwaukee, for example. And that's exactly why they're doing it, because they haven't been able to give Milwaukee employees a raise in like 3 years. So they're promoting and supporting them in PSLF as sort of an alternative to that. So I'm done with my soapbox. All right, I'm not seeing any other questions. I'm seeing some very kind words, which I appreciate very much. Thank you. And of course, if you get off this and you have other questions, don't forget we give free advice via email. You can just go to our website and go to the contact page and email us through our TSLA email. And with that, I am going to stop the recording.